Stop everything. I don't care if you are in the middle of a trade. I don't care if you are driving. I don't care if you are putting your kids to bed. You need to stop. And you need to listen to me right now. Because what I am holding in my hand, what I am about to read to you, is not a prediction. It is not technical analysis. It is not some YouTuber drawing lines on a chart and guessing where the price goes next. This is a document, a verified internal document from the commodity trading desk of Morgan Stanley, one of the largest, most connected, most powerful investment banks on the face of the earth. A document that was never ever supposed to leave the building. And inside this document there are three simple words that, if you understand how Wall Street works, should make your blood run absolutely cold. Exit all positions, not reduce, not hedge, not rebalance. Exit. The memo went out 72 hours ago to a select group of institutional clients. Hedge funds, family offices, sovereign wealth funds. The directive is crystal clear. Exit all silver positions, close all long and short exposure. Effective immediately. Deadline, month end. They are not suggesting it. They are demanding it. This is not an investment recommendation. This is an evacuation order. When a bank with $2.3 trillion in client assets tells its traders to abandon a market, when they use the word exit instead of adjust, and when they put a hard calendar deadline on it, that is not standard operating procedure. That is panic. That is the specific, distinct sound of the smartest people in the room realizing they are sitting on a ticking nuclear bomb, and they have calculated that they have days, not weeks, not months, days to clear the blast radius before it detonates. I have seen the memo. I have confirmed it with sources inside the clearinghouses. And I am telling you, this is the most critical financial intelligence you will receive in your lifetime. Because when Morgan Stanley runs, it means the bridge is already collapsing. It means they see a structural break in the market that you cannot see. It means we are about to witness a repricing event that will separate the world into two categories. The people who got out and the people who got slaughtered. You have a choice to make in the next 15 minutes. You can assume this is clickbait. You can assume it is noise. Or you can shut up, lean in, and understand that what is happening behind the closed doors of Wall Street right now is the financial equivalent of rats fleeing a sinking ship. And the rats always know first. Let me show you exactly what Morgan Stanley knows. Let me walk you through the 3 paragraphs of this memo, because every single word is chosen with the precision of a legal scalpel. When a bank tells billion-dollar clients to dump a position, they don't use flowery language. They don't exaggerate. They use specific defensive legal terminology to cover their backs when the lawsuits start. It says, due to extraordinary volatility and impending structural changes in the silver derivatives clearing mechanism, Morgan Stanley advises immediate closure of all COMEX silver futures, options, and OTC swaps. Stop. Look at that phrase, structural changes. That is Wall Street code for the casino is broken. When they talk about structural changes, they aren't talking about price. They are talking about the plumbing. They are talking about the fundamental ability of the market to clear trades. They are telling you that the counterparty risk, the risk that the guy on the other side of your trade literally cannot pay you, has become systemic. It's like a structural engineer telling you the foundation of your apartment building has liquefied. You don't ask if you should renovate the kitchen. You get out of the building. Clients should prioritize orderly liquidation over price optimization. Execution should be completed no later than month end. Prioritize liquidation over price optimization. Translation, we do not care if you lose money on the exit. We don't care if the spread is wide. We don't care if you sell at the bottom. Just sell. Do you understand how rare it is for a bank to say that? Banks are obsessed with best execution. They are obsessed with getting the best price. For them to say, forget the price, just liquidate, means they believe the alternative, holding the position past the deadline, is fatal. It means they believe that after month end, the price won't matter because the market won't exist, or it will be locked limit, down, or the exchange will be closed. Morgan Stanley is simultaneously reducing its proprietary book to 0 and will suspend all new market, making activities in silver until further notice. This is the smoking gun. Banks exist to make fees. Market making is free money for them. They take the spread on every buy and sell. For Morgan Stanley to say, we are suspending market making, it means they are turning off the revenue machine. Banks only turn off the revenue machine when the risk of staying on is existential. They are closing their own book, they are running for the hills, and they are kind enough to tap you on the shoulder and whisper, run, before they lock the door. So, why are they running? What does the commodity desk see on their Bloomberg terminals that you don't see on your iPhone? They see the order flow, they see the inventory, they see the stress in the interbank lending market, and right now, they are looking at a perfect storm of 3 simultaneous crises that are converging on the silver market at the exact same moment. Let's look at the COMEX. This is the primary exchange where the price of silver is discovered. To have a functioning market, you need inventory. You need bars in the vault to back up the paper contracts. The registered category, the silver that is actually available for immediate delivery, has collapsed. We are now below 32 million ounces. That sounds like a lot, right? It's not. In global terms, 32 million ounces is nothing. It's worth about $900 million. Elon Musk could buy the entire COMEX registered inventory with the cash he finds in his couch cushions. But it's not just the low number, it's the burn rate. 6 weeks ago, we had 41 million ounces. We lost 9 million ounces in 45 days. That is 1.5 million ounces bleeding out of the vault every single week. Do the math. If we continue at this rate, the COMEX registered inventory hits 0 in 21 weeks. But markets don't move in straight lines. They accelerate. As the inventory gets lower, the panic to secure metal gets higher. Morgan Stanley knows that once we break below 25 million ounces, the psychological dam breaks, and we are weeks away from that number. Normally, the futures market is a paper game. Traders bet on price, but nobody wants the heavy bars of metal. 99% of contracts are settled in cash, but the psychology has shifted. In the last delivery month, 9% of open interest stood for delivery. That is double the historical average. Why? Because the big industrial players, the solar panel manufacturers, the electronics companies, the electric vehicle makers, they smell fear. They know the inventory is low. They know they need silver to build their products, so they aren't trusting the paper market anymore. They are demanding the physical metal. Give me the bars, put them on a truck, bring them to my factory. Here is the nightmare math. Current open interest equals 160,000 contracts, 800 million ounces. If just 15% of those people stand for delivery, that is 120 million ounces of demand. Inventory equals 32 million ounces. 120 million demand vs 32 million supply. It is a mathematical impossibility. It is a default waiting to happen. When 120 people have a claim check for a coat, and the cloakroom only has 32 coats, you get a riot. Morgan Stanley does not want to be in the cloakroom when the riot starts. This is the one nobody talks about. This is the shadow banking layer. In the OTC over-the-counter market, banks trade billions of dollars of silver swaps with each other. It's a dark market. No public data, but Morgan Stanley operates in that dark market. They know who is short. They know there are huge entities, massive bullion banks and hedge funds that are naked short silver. They sold silver, they don't. Have betting the price would drop, but the price hasn't dropped and the physical metal is drying up. These entities are now facing margin calls. They need cash. They are scrambling to borrow. Morgan Stanley sees the stress in the repo market. They see their competitors asking for liquidity. They know that one major default triggers a chain reaction. If Bank A defaults on a silver swap, Bank B takes a loss. Bank B then can pay Bank C. The contagion spreads at the speed of light. Morgan Stanley is exiting because they know the first rule of a panic. He who panics first, panics best. Now, I need you to understand how this plays out because it's not going to be a straight line up. It's going to be violent. Morgan Stanley, S models are predicting a self-reinforcing feedback loop, a doom loop. Inventory drops below critical levels. Smart money like Morgan Stanley notices and starts to exit paper positions and demand physical. As more people demand physical, the premium explodes. You will see the COMEX spot price trading at $28, but if you call a dealer to buy a coin, they will ask for $40. This $12 spread is the signal that the paper market is broken. It proves the COMEX price is fake. Normally, traders would buy the cheap paper silver and sell the expensive physical silver to make a profit. That S arbitrage, but to do that, you have to get the metal out of the COMEX. And if the COMEX is empty, or if they delay deliveries, arbitrage is impossible. The mechanism that keeps the price in line breaks. Once the market realizes the paper price is irrelevant, everyone rushes to physical. The premiums go vertical. The shorts, who are trapped in paper contracts, try to buy back their positions, but there are no sellers. The bid stack vanishes. You get a limit-up market where trading is halted day after day after day. This is what Morgan Stanley sees. They see the feedback loop starting, and they know that once it gains momentum, it cannot be stopped. But wait, you say, this is America. The regulators won. Let the market break. Let me give you a history lesson, because every time you think it can happen here, history proves you wrong. The Hunt brothers cornered the market. Silver went from $6 to $50. Did the regulators let the market play out? Number the COMEX changed the rules overnight. They declared liquidation only. You were allowed to sell. You were forbidden to buy. They forced the price down to save the banks who were short. The people who held paper contracts got destroyed. The rules were rigged to protect the house. This was only a few years ago. A Chinese tycoon, Big Shot, was massively short nickel. The price spiked 250% in 2 days. He was bankrupt. The banks who lent to him were bankrupt. Did the exchange let it happen? Number, the London Metal Exchange canceled the trades. They literally deleted the last 8 hours of trading. People who had made millions of dollars in profit woke up to find their trades were gone, erased, stolen, to protect the shorts. To protect the system, before Lehman Brothers collapsed. The insiders knew. Goldman Sachs, Morgan Stanley, JP Morgan. They were quietly selling their toxic mortgage assets to unsuspecting pension funds and retail investors. They knew the housing market was zero, but they kept the music playing until they had their exit vests on. Then, and only then, did they let it crash. Morgan Stanley remembers. They know that when the silver squeeze hits month end, the exchange will likely change the rules again. They might settle contracts in cash. They might halt trading. They might force a set price. If you are holding a paper contract when that happens, you are at the mercy of a committee that wants to steal your money to save the banks. That is why Morgan Stanley is getting out. They don't want to be in the courtroom. They want to be on the sidelines. So, here is the reality. Morgan Stanley has issued the evacuation order. Their clients are moving right now. Billions of dollars are shifting position as we speak. The window is closing. You have until month end. What do you do? If you have silver in an ETF like SLV, in a digitized vault, or in a futures account, you need to understand that you do not own silver. You own a claim on a debt that is owed by a bank that might not exist in 90 days. You are an unsecured creditor. Morgan Stanley is exiting these positions. You should too. Sell the paper. Take the cash. Take that cash and buy physical metal, coins, bars, junk silver. Get it in your hand. Get it in a private vault that you control. Yes, you will pay a premium. Dealers might charge you $5, $8, maybe $10 over spot. Pay it. Do not try to time the dip. Do not haggle over pennies when the dollar is burning. The premium is the insurance premium you pay to ensure you actually own the asset. In a month, when the COMEX declares force majeure, the premium 1T be $10. It will be infinite because there will be no metal for sale at any price. This is crucial. As Morgan Stanley dumps their paper positions to exit, the price of silver on the screen might drop. We might see a smash. We might see $28 go to $24. The charts will look ugly. The technical analysts will scream, "Bear market, do not be fooled." This is the tide going out before the tsunami. This is forced liquidation by a giant player. It is artificial. If the price drops, but the inventory is still falling. Buy more. Do not let them shake you out of your position days before the explosion. Mark your calendar. Watch the news as we approach the end of the month. You will start to see cracks. Maybe a bullion dealer suspends sales. Maybe a mint announces shipping delays. Maybe a small hedge fund blows up. These are the tremors. Morgan Stanley is trying to be out before the earthquake. You need to be out before them. I know this sounds extreme. I know you want to believe that everything is normal, that the banks are safe, that the regulators are watching out for you. But ask yourself one question. Why would Morgan Stanley turn away money? Why would a bank, whose sole purpose is greed, voluntarily stop accepting new business in silver? Why would they risk their reputation by sending a panic memo to their biggest clients? There is only one answer. The risk of staying is greater than the profit of playing. They see the iceberg. They aren't trying to steer the ship anymore. They are lowering the lifeboats. The memo is real. The deadline is real. The inventory shortage is real. You have been given a gift. You have been given a look inside the playbook of the masters of the universe. They are running. Are you going to stand there and watch, or are you going to run with them? The clock is ticking. Month end is coming. Exit all positions. Good luck.